Good evening, investors. First of all, I would like to welcome Ashwini Patni, who is a fund manager and head products from Axis Mutual Fund, who is sitting on the right to me. I am Sambat Kumar. I head the products for HDFC Securities. There's been a sincere apologies that I would like to extend because there was a delay in the fund manager joining us at 4 o'clock. So he's expected any time. When can we expect him?
Hopefully in about 10-15 minutes.
10-15 minutes. Meanwhile, Ashwini, I would request, there are more than 2,000, 3,000 customers, eager customers who are waiting to hear from the Axis Mutual Fund perspective on various aspects, very specific they have been, and this is a very complete retail investors who are very, very keen in wanting to know why ELSS and why Axis Long-Term Equity Fund, what is the significance. I'm sure most of our investors have benefited with the kind of returns we have given in the past. But the frequent asked questions here also, I can see some 100 questions asked by our investors. Is it the right time? Why ELSS? And I'm sure these questions are popping out in investors' mind again and again. I'm sure you are the best person to handle this. So over to you. You can just cover up all these doubts in the investors' mind.
Thank you so much. Good afternoon, good evening, everyone. Let me start by maybe taking 5-10 minutes to just set the context of why long-term investing in equity markets, and given the context, where are we in equity markets and how does it help? And then we can take it from there to, once we have agreed that equity markets are looking very interesting, then, how does ELSS and subsequently Axis long-term equity help you in participating in the same? If you look at the equity markets in India, I think over the long term, last 15-20 years, they've had fantastic wealth generation tool for all investors. Sadly, however, for a large number of retail Indian investors, that wealth participation or the generation in that participation in that wealth generation has been fairly limited. Why does that so? It happens because for a lot of us, there is no mandatory allocation to equities. Most of our traditionally the saving instruments that we have been used to are more fixed income oriented, whether they could be on the PF side, on fixed deposit side, whatever else that we allocate typically is on that side. To a certain extent, the discretionary allocations are all gone to other asset classes like gold and real estate, etc. So equity has not been favored. Second thing which is also not helpful is equity markets being necessarily by their nature a little bit more volatile, jumpy, up and down. That also tends to put off many investors. So they tend to focus a lot about the near term or day to day or month to month ups and downs in the market. That affects them. As a result, what we have seen, if you see the last 15-20 years, people who have been invested in this market have enjoyed a return which is far superior to many other asset classes. Just to give some numbers, anywhere between 12 to 15% per annum returns have been enjoyed depending on which part of the market you've been invested in. Sadly, some of these returns have been enjoyed much more by, for example, foreign investors than domestic investors, because we've had very good, successful, long-term history of rewarding foreign investors because they had the patience, they had the foresight of coming and investing in India at an early stage. Now, of course, all of this is in the past. Sitting today, what we have seen in the last few years is a huge amount of interest coming into investing in stock market. I think what is very useful is this ELSS, the Equity Linked Savings Scheme, is a fantastic tool which the government has put together for encouraging long-term savings, giving a tax benefit to investors to allow them to participate in the stock market in a long-term way. And it is a fantastic tool. While in the past, of course, the wealth generation we have seen in the market, what is the way forward? How does the markets look going forward over the next 3, 5, 10 years? And I think the potential is very much there to continue the kind of wealth generation that we have seen over the last so many years is way forward as well. Many of you who are tracking the news flow, who are seeing the kind of work that the government has done, looking at the data, they are aware that last 2-3 years, a lot of hard work has gone in terms of the kind of policy making government has done, the kind of turnaround that we have seen in the fortunes of the economy, whether it is in terms of targeting, lower inflation, bringing down interest rates, getting our currency into a more stable mode, improving ease of business, promoting FDI investments, promoting investments from foreign investors, etc. So a lot of these work has gone down in terms of making our growth rate as an economy to a more sounder footing, on a higher footing going forward. And all the fruits of all this work we think is going to come out over the next 1 or 2 years, starting over the next 1 or 2 years, and but hopefully sustain over beyond that as well. So therefore, what happens is that as growth gets better, ultimately when you invest in equity markets, the key thing that you are really looking for in terms of your ability to make reasonable return is to see growth, because equity is participation in the cash flows, participation in profits, and that cash flow profits benefits or improves as companies are able to grow their businesses, grow their profitability over time. And that is how the equity markets rewards investors by improving the valuation of companies which are able to grow their cash flows, grow their profits over time. So sitting today, looking at over the next 3-5 years, the kind of growth prospects that are there in the Indian economy, the kind of potential we have to continue to grow is fantastic. A lot of the hard work that we have done last 2-3 years as a country, as the policy making side, on the RBI side, is all going to come and help us. The second thing I will also talk about is that we have seen a huge burst of entrepreneurship, innovation at an Indian promoter level. So the Indian companies have always been very, very nimble-footed. They've been very quick to take advantage of opportunities in the market, and that is one of the reasons why Indian stock markets have done so well, because we have a large, vibrant set of private sector companies. So again, when these opportunities are opening up today, a lot of new sectors opening up, a lot of us are aware of what things that are happening on the technology side, for example, e-commerce side, a lot of new sectors opening up in the economy as we go through a new wave of progress. And again, we have the potential for companies to, or the entrepreneurs to set up new business models, take advantage of growth opportunities in these new sectors, sunrise sectors, and grow their operations and profits over time. So all in all, it is a very exciting phase, a very interesting phase, where both the two parameters from the economic backdrop is quite positive, as well as on the company's side, we are seeing a lot of vibrancy, a lot of enthusiasm, a lot of confidence in terms of the way forward that the companies are able to see from the market. As far as the third leg is concerned, typically this is, of course, all of these parameters are more domestic in nature. The third leg is what is happening around the world, outside of India, around us. Which is probably one area where there is a little bit of a sort of, I won't say concern, but a little bit of a question mark, because many of the countries, as again many of you who have seen the news flow over the last year, 2-3 years, are aware that many countries are going through challenging times in terms of their growth not being so good, or they're going through some economic challenges of their own. All of these do affect our India in a indirect way, and this does affect some way our ability to grow at a very fast pace. So yes, there are some challenges which may come from the global context, or from places where there are challenges. We have seen challenges in China, we've seen challenges in Europe, etc. But otherwise, if you adjust for that, if you look at the domestic economy, domestic vibrancy in terms of the domestic promoters, they are doing very fantastic work. So all in all, I will summarize by saying that last 10-15 years we have seen a fantastic growth, wealth generation in Indian stock markets for those investors who had the foresight, patience to come in and invest and stay invested. Last 2-3 years, again, while we had gone through some blips in the past, last 2-3 years again, a lot of good work has been done by the government, which is allowing the markets, the economy to again find their footing. And investors can, those who choose to invest now, can look at a great way forward if they remain invested with discipline over the next 3-5 years. And this is where I think the ELSS structure comes in very handy. Just to summarize for those of you who are not aware, the ELSS structure is essentially a dedicated fund which is designed called equity linked savings schemes. They invest in Indian equities. There is a 3-year lock-in. So investors who invest on any given day have to remain committed to the fund for at least 3 years, and they can choose to remain invested beyond that as well. And like I said, being an equity fund, the money that is invested in these funds is used by the fund manager to allocate across a portfolio of Indian stocks. So if you look at the background that I gave, which is the wealth generation opportunity that we have way forward, and I mentioned that over the last 15 years, 12 to 15% kind of annualized return equity markets were able to generate. Then if you look at the kind of wealth generation opportunity, then setting aside this money is a fantastic option for investors, whether they are looking at a tax benefit or whether they are looking at a pure investment opportunity from a longer term perspective. And that is where ELSS comes in very handy. Now, within ELSS, from an Axis mutual fund perspective, our offering that is there is called the Axis Long Term Equity Fund. It's a very unique product within the mutual fund industry and also within the context of ELSS. What we have tried to do here, and just to give a quick summary of the product, what we have tried to do here is set up a structure. You take the advantage of the 3-year horizon that investors have, and to take advantage of that, to create an investment philosophy that is able to take advantage of that and create a portfolio of companies that have great long-term growth potential, where we can really back them over a cycle, not worry too much about ups and downs over the short term, over 3 months, 6 month performance, but really back companies which have fantastic growth opportunity, very good quality, fantastic growth opportunity over a 3-5 year window, and really ride their growth over the long term and really maximize the wealth potential that can be generated from these companies over the long term. So this is a strategy that is really, we have really rewarded our investors over the last 6-7 years. The fund has now been available for last more than almost 7 years, and over this time, the compounding that we have seen across a number of the stocks that we have invested in, we have been able to play out this kind of an approach that we have. And again, I will go back to this, that equity investing is for the long term. It is not meant for more tactical or short term, unlike, let's say, a fixed deposit, or unlike some other instrument where you can put money for 6 months, 12 months, shorter periods also. Inherently, equity markets, only to get the correct outcome from them, to get a reasonable outcome from them, you have to be invested for the long term, and that is where ELSS structure comes so handy, and that is where within ELSS Axis Long Term Equity Fund is also a fantastic approach that we have. Take advantage of the fact that investors is giving money for 3 years, find those kind of opportunities where we can get the maximum sort of wealth creation potential or growth potential from a 3-5 year perspective, and that is what we have tried to do.
Sure. I think certainly, Ashwin, I think that's what even the market, the investors, more than 100 questions has been asked. The frequently questions has been on why and when. But I think few questions which keep repeatedly coming from the investors' perspective as well is it the right time? Is there anything called right time to invest in ELSS? And this 3-year lock-in period, how will it impact the fund? That is something which would you like to touch upon that, Sanjay?
Yeah. So let me take them question by question. The first one is, and that is probably the one question that we get asked by most, and it is a very valid question from an investor's perspective, who's especially from newer investors who are looking to allocate it. Is it the right time? So I know that I should be investing in, philosophically I agree that I should be investing in ELSS. But what if I invest now and the market goes through some big correction? Or what if I invest now and is this the right time? Could there be some kind of a risk that I invest? Can I avoid some mistake? Can I wait for a better time? So these are typically, it's very fair to have these kinds of worries when one is making some allocations of money and in the market. But to be very fair, unfortunately, the reality of the market is that nobody really knows how the future will play out. There is a certain amount of volatility that is inherent in the market. And yes, ups and downs can very much be expected. But equally, what we have seen is there is no time like right time or wrong time. If you go back to the last, like I take the example of the last 15-20 years that you see in the market. Even if somebody had invested at the worst times, like the peak of the market after a big correction, but if they remained invested for a reasonable period of 5-6 years, they still got a reasonable return. Very difficult for anyone to be able to correctly predict what is a good time, in advance. Afterwards, it's always easier because you knew that there was something happened and market corrected, things like that. But in advance, it becomes difficult. So my recommendation would be, don't worry about trying to time the market. Be worried about volatility, of course, but the way to handle volatility is not by procrastinating, but by, for example, using simpler tools like regular investing. If you do regular investing, then your risk of any one installment comes down. You spread your investments over regular periods, so things like SIP or even regular investments on lump sum basis allow you to de-risk your investment to a large extent.
So thanks for that, Ashwin. And what do you think? I think SIP is something which they can look at it at this point of time from Axis Long Term Equity. Would you recommend to our investors as well? Because we have close to more than 5,000 or 6,000 investors who has been investing already in Access long-term equity, and there are more investors who are keen in looking at SIP route for this access. So, what do you think you should be giving a solution for those kind of investors?
So I think SIPs is our number one recommended route for investing for any investor who is looking, and more so for any sort of smaller investor or investors who are relatively newer to equity markets, who are still building up their equity allocation. Then SIP is the preferred, most recommended option that we always suggest investors. It works beautifully in the equity market context because not only does it help you, like I said, in the earlier question, that if you're worried about timing and the correction, it helps you spread out your risk over a longer period. But more importantly, it actually you are able to take advantage of ups and downs in the market. Let me explain.
Yeah.
If the market falls, what SIP really does is you take a fixed amount, so whether it is 2,000 rupees a month, 5,000 rupees a month, whatever the amount is. Suppose you go for a 5,000 rupees a month SIP. Then if you invest 5,000 rupees per month regularly every month, then how the SIP will work is, in the month when market has fallen, that 5,000 rupees actually you are able to buy more units or more part of the market for the same value. Whereas in the months when market is up, because the prices are higher, you buy lower units. So you are getting a situation effectively where you are buying more when the prices are lower and buying less when the prices are higher. So effectively you are doing a good averaging, which SIP is allowing you to do. And in effect, that is a fantastic way of managing risk over the shorter term, medium term in the market. It also, like I said, de-risks you, it protects you from not getting too exposed to any event in the market. So yes, SIP is a highly recommended way of investing.
Sure, I think we have also been doing that. I think investors also been trying to do that. If I have to ask you, the question is, why Access? So we have the complete conviction as a broking fraternity. We have believed it, and our investors have believed and been holding it for quite some time on the Access long-term equity. If I have to ask you 3 points, which at this point of time, why Access long-term equity? Would you like to? What are the points you think our investors should know?
Yes. I think number one is the unique thing that is there about this product. The number one unique point is the philosophy or the way in which we manage this fund. So if you look at the fund, we have the most unique approach towards this. In any ELSS product, you get long-term money from investors. Investors are insulated from ups and downs in the market because they don't have to, when they're committing money for 3 years, so they don't have to worry about 3 months, 6 months, 12 month kind of. So they need a strategy which can really take advantage of this. So the number one thing is, we have a long-term oriented approach which correctly takes advantage of the ELSS structure. Number two is the quality bias that we have. So if you look at the portfolio, it is a very compact portfolio. We only invest in stocks where we have very high comfort, conviction in terms of the management quality, the balance sheet quality, the kind of sustainable business model that the companies have. So we do a lot of hard work in making sure that only those companies come in the portfolio where we have very good level of conviction. Their quality is fantastic over a 3-5 years. And the third thing, of course, is that our consistency in terms of following the same approach and the rewards that we have been able to generate for the investors because of that approach. So that is the reasons why we feel that Access long-term equity is a great option for investors who are looking at ELSS.
Sure. I think there's already a couple of investors asking us how to invest. I think for that, I think I would be the better person to tell. You can just go into our HDFC Securities site, and if you have an account, you just go to the mutual fund page, and you can select all those schemes available. And in the ELSS category, you can start investing. That is quite possible because people wanting to know how to invest on ELSS. And again, the question comes is this month or in for someone like a retired professional, what do you, I mean, even though it is considered in the tax bracket, we sell it that we push to the investor, it's a tax haven kind of a product. There are a couple of guys who are looking at as an investment opportunity for someone like retired professional. Would you still want to suggest as an asset allocation kind of a product? Would you recommend?
Yeah. So no, that's a very important question, because you have to, when you're looking at any investment, you have to look at your condition in life or your background, and you cannot see any investment in isolation. So for example, in this case, the question is that the condition, the background is that you are going through a retired phase. What is and I'm so sure HDFC has a very detailed way of managing this, but very quick explanation that I can give is that for any person, the correct thing to do is to understand what is the horizon. So even for a retired person, for example, if you have recently retired, you could have a 15-20 year horizon ahead of you where your savings have to work for you and work against inflation, work against other challenges, and arrive at what kind of risk appetite you have, etc. And this allows you to really decide that if you have a pot of, let's say, 100 rupees, part of that pot can go into equities, part of that pot can go into other lower risk instruments like fixed income, etc. And of course, if I were to compare the kind of allocation that a retired person could make to equities, would probably be lower than what, let's say, a much younger person who's starting out in life, maybe at 30 years, 25 years, just started working, the risk appetite, the ability to take losses is much higher. So yes, there is scope for everyone, even let's say retired person, to have some allocations to equity, as long as they are taking a very informed decision, looking at their overall total investment pie, making a reasonable allocation to equity in the light of whatever risk they are capable of handling. But within that, yes, once they have done all this work, yes, they can definitely look at equity.
Ashwin, the other question, now that it's not related to the scheme specific, now that we have been discussing about scheme specific, everyone is more worried about, or rather concerned about the tomorrow's factor. So would you just like to touch upon, because I just can't keep on skipping those questions. Everyone wants just to have a quick view on that. Would you like to
Yes, I
just touch
think
upon?
you can't avoid that topic today at all. It is obviously something that is playing on everyone's mind, including market watchers, including lay, people, observers, etc. Sadly, why is as we all know, US is the biggest economy in the world. What happens in the US does affect the rest of the world. So it is not unfair for us sitting here also to be tuned in or to be keeping track of important developments in the US. Ultimately, to be honest, we don't see there will the good news is, because US, like any developed economy, there is a certain amount of continuity that is always there in terms of policies and practices. And yes, there are certain differences in terms of how certain domestic policies will get implemented, but by and large, day-to-day life does not change too much by these things. So our reading of it is, yes, effectively the choice is between someone who is very well known and has a strong political background versus somebody else who's not so well known and is a relatively new person, is a relatively new person within the political space. So, and that is what is, to be honest, currently creating some amount of uncertainty. Because the one of the persons is not have a political background, so doesn't know what kind of policies that may come. My simple advice to people, from an Indian, very localized Indian investor perspective, is that events will always be there. 6 months ago we had the UK poll about referendum about the EU. 1 year ago we had the Greece vote about the EU. You had something about in China. So these things will come and go. If you look at the last 15 years in Indian markets, there have been so many events. You had dot-com bubble, you had 2008 crisis. So many severe incidents will come and go. These are events that are part and parcel of day-to-day life. As investors, we have to really look at our own regular investments. If we are able to do that, I don't think we have to worry too much. Yes, some short-term volatility can be there, of course, if things are a surprise tomorrow. But we are not anybody who's investing from a 2-3 year horizon, longer horizon, I don't think there is anything to worry.
Fine. Thank you so much, Ashwin. I think now that Jinesh has stepped in, may I request Jinesh to just join in? Yeah, if you can just step in.
Yeah,
The camera is there, so we'll have to sit here. Sure. Sure. So, so Jinesh, very good evening, and we have almost 2,000 to 3,000 investors there. First of all, I would like to welcome you from HDFC Securities. And one thing is very evident from these investors: one, they have a lot of patience in terms of holding on to the scheme as well, and to see you as well, because still we have close to 2,000, 2,500 investors since the beginning at 4 o'clock wanting to listen to you.
Apologies from my side, because I got late in one meeting and could not cut that meeting and come. So frankly, sincere apologies from my side for coming on late. So sorry for taking your time, and I hope Ashwin would have covered.
Yeah, he did cover, but certainly people are very keen to hear from you on, the whole investors have been here invited to hear from you
Sure,
on
sure.
what is the view on the ELSS and what is the market perspective and why long-term equity fund. Maybe it would be glad if you can give your
So
perspective.
market, I'm sure
I'm sure he
Ashwin
covered
would have,
that, yeah.
would have covered it. So means as a house, we feel that these are all events which come and go.
Yeah.
More to do with the US election which is coming into place, then December rate hike, and so there will be volatility in the markets. However, if you take India, is in the sweet spot. You are getting money. There is a good FII inflow which has happened over the last 2 years after the new government has come in. So to that extent, we don't see any significant trouble unless and until there is a significant hikes in interest rates in US, because then again that hot money which was coming will go away. From the economy perspective, I think we are seeing more better times rather than bad times. The monsoons are good, rural economy is picking up, then you have pay commission in place, then you have some of the infrastructure stories like roads, railways picking up. Although it is slow, but things are moving in right direction. There is a reform, especially on GST, which is a tough reform, and I think after 10 years it is being executed, and how the implementation will come will be seen. But at least there is a roadmap for next 10 years under Mr. Modi, how India should look like. So we are very bullish from India perspective, and more so from the market on the stock specific side rather than on the broader, let's say Nifty or Sensex. If you see the actions in the particular sectors like consumption or private banks or NBFC, the amount of money which is being made in terms of returns is humongous, predominantly due to the company earning numbers has been phenomenal. The companies are growing at 20-30% with decent asset quality, and it is more to do with penetration levels, more customer acquisition, and more kind of robust technology being put into place vis-a-vis the PSUs of the world. I'm more talking on the private bank NBFC versus the PSU bank. So there is enough opportunity for investments if you are able to pick and choose few stories in your portfolio, and that is has been all about our forte in terms of bottom up stock picking. And coming to ELSS, I would say the story has been the same. Last 7 years, identify good stories, identify good management, identify good business model, cash flows, ROEs, and be with them over a longer period of time. So if you see the portfolio, the I think the average age of the stock in the portfolio has been around 3.5, 4 years, and we have stuck to that rather than doing lot of excessive churning. Why ELSS? For a fund manager, it is important for a fund manager to have a stable money flow as well as the stable money lying in the portfolio. So given the 3 year lock-in nature, I can virtually invest like a entrepreneur, or a management, see the vision mission of the company, understand the business model, do more diligent checks over a period of 1 year 2 year, and then and go all out and investment with a 3 to 5 year horizon. So that is how, if you see most of the stories what we have played, we have still not exited despite they giving us multi-bagger returns over last 6-7 years. And we continue to do so, and we'll keep on doing the same stuff again and again. Identify good stories, identify good management, identify good business model, and be with them from a longer period of time. So ELSS, I think 7 years back when we started the entire campaign on ELSS, everybody had ELSS, but it was not the, I think, the flagship type of a product to pitch to the client. So it was one of the product. But when we saw it as an opportunity like private equity or a pipe fund, we thought that why not we take this approach, have a concentrated bet in the portfolio, and ride the wave. And luckily, the stories which we bought have done exceedingly well. There are misses, so I would not say we are like 100% right. Even if we are 60-70% right, that we are in the game. So we have done enough due diligence, in-house research, what we continue to do with our team members, and the stories which are at, let's say, small cap have become large caps, mid caps have become large caps. There will be misses. So some stories which are mid cap has become small cap, but that is part and parcel of the game. So again, the 3 year lock-in helps the fund manager in terms of having a conviction in the portfolio.
Okay.
So the churning rates are very low. Once we get into the business, we see to it that we ride the wave. Unless and until there is a significant change in the strategy of the management for the business, we don't exit. So I will just take one example which I always like is Eicher Motors. In the two-wheeler space, the entire other two-wheeler pack was growing at 8-10%, whereas this company, because of its product category, it was growing at 40-50%. I invested when it was around, let's say, $400 million market cap, and now it is close to $7-8 billion of market cap. So, and we are still riding that wave. If it would have been, let's say, a strategy to get out in 30% return, then I would have missed the entire multi-bagger opportunity. So long the management is good, management is focusing on day in, day out on the same strategy what they are articulating, we don't see any problem. Obviously, there will be times where the valuations will remain expensive, and that has remained expensive for 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 the reason because there is growth, there is profitability, there is ROE, return on equity on that business model among the pack of two wheelers where others are having a, let's say, ROE of 20%, but the growth is just 5-7%, whereas this guy is delivering 30% ROE where growth is also 40-50%. So long that growth momentum continues, and we are predominantly a house looking into growth option rather than value option in terms of identifying the stocks, identifying the business models, rather than taking those bets at let's say 1 time price to book or 3 time price to book, and just hoping that they will re-rate. We think that it should be business which should be valued, not the stock price. So to that extent, we have been able to touch wood. We have been able to identify stories, and our job will be to keep on identifying it every now and then.
So great, Jinesh. I think one thing I wanted to highlight to you as well as the conviction we had in this scheme for the last 7 years. It has been recommended by HDFC Securities very aggressively. So we have more conviction in you rather than you yourself having in you. That is something which we can proudly say about it. I think the next question or last two questions is frequently asked by to our dealers and through our online channel as well. Customers keep asking us, as today the fund size, the frequently asked question. You are the victim of your own success, as they always say. So today the fund size being, do you find that as an obstacle, or would you like
So
to?
my sales guys keep on asking me when we touch 3,000 crores. So from 3,000 we went to 5,000, 5,000. We are now at almost 11,000 crores.
Yeah.
See, it's a challenge. I would not say it is not a challenge, to be very frank, but it's a good challenge. In India, there are only 4 or 5 fund managers who has this challenge, I would say.
Absolutely.
So there are only 4 or 5 schemes who are running this kind of a mandate. Worldwide, if you see, there are many fund managers who are running very big mandates. My whole thesis is that if India has to grow and if there is a GDP growth, you link market cap to GDP, and if market cap keeps on growing for particular sector, particular company, and and the overall index, then there shouldn't be an issue to manage this kind of numbers. Obviously, if the reverse come, let's say Modi government doesn't come into power and market crashes, then obviously the single biggest risk is the liquidity risk, where you guys go for redemption and we cannot exit the stock. Again, the positive part for me has been the lock-in nature of the product. So at least I know how much money is going to get exited by 1st of April for the following 12 months. So even if my sales guys can bring in that much amount of money, I am not worried from the portfolio perspective. But because at the end of the day, there is an investor. I don't want to make it. I don't want to come to the point that the existing investors are losing money just because I need to exit.
Yes,
Because of few redemptions, right? So it's a good challenge. We are also grappling with that for the first time. I am also grappling with that for the first time in my experience. We are trying to manage it as much as possible. Still, the concentration of the portfolio is intact. We have around 38 to 40 stories. Even if you take 4 years back, we had similar stories.
Okay.
So long the market cap of the companies where we have invested keeps on growing, and they get participated in the mid cap index or the large cap index, we don't see liquidity as an issue.
Okay.
However, if reverse happens, let's say the market crashes, then obviously there will be problem. But in a hindsight, even that would be problem for a 500 crore scheme also, because the kind of stocks what he would have bought might not be liquid as well. So it's a good problem, I would say. We are trying to manage it as much as possible.
Fair, Jinesh. I think those are the finer words, and we would like to hear. We were actually wanting to hear that from you only, so that the investors as such are already asking the route to invest, how to invest. I'm sure that next few months and few days that we will find more investors coming into your scheme as well, especially through us. And before closing, would you like to add any final points from both of you? Then we can close. You would like to add anything?
No, I think we'll just summarize.
Ashwin.
Thanks so much for having us here, and we look forward to working together with HDFC. It's been a long, fruitful partnership for us. Just reiterate that it's a fantastic context. Tomorrow's the event that we are seeing. It's just gives us the context that these kind of events will always be there in the market. Don't worry too much. Don't read too much about any one event, any one day in the market. Make sure you invest regularly. Make sure you stay disciplined for the long term. And if you're doing that, then last 15 years have shown what kind of fantastic wealth generation is possible in the Indian markets. And no reason why over the next 5, 10, 15 years, similar kind of wealth generation cannot be done again. So just remain regular, remain disciplined. That is the only way of.
That is exactly what we are.
Again, apologies from my side for coming late.
No, that's absolutely fair. We have informed them as well about this delay, and on the behalf of all our investors, close to 4,000, 5,000 investors who have participated and registered, I would like to sincerely thank Jinesh and Ashwin to participate and clear almost all the questions. And for the investors who have mailed us all the queries, all your remaining queries would be answered as well through our customer care desk. So we'll meet in next another webinar with more interactive sessions. Thank you, everyone. Thank you so much.
Thank you. Thanks.
Thank you.
Thank you.